Hey everybody, this is OG John here, and what I am about to tell you today might leave you in shock as it did to me. But someone has to speak about this. $311. That's how much gold moved in a single trading session today. The largest one-day dollar gain since 2008. Not since Lehman Brothers collapsed. Not since the global financial system nearly imploded. That was the last time we saw this kind of violence in gold's price action. $2 trillion in market capitalization shift in one session. To put that in perspective, that's roughly the entire market value of Amazon. No CEO announcement, no earnings call, no board meeting restructuring strategy, just the oldest form of money on earth reminding markets it's still here, still relevant, still the ultimate arbiter when paper systems come under stress. Gold up 6% today, $286 per ounce, silver up 14%. And here's what matters. When gold, silver, and copper all surge together, it's not speculation, it's not a sector rotation. It's the system repricing what money actually is. It's market structure revealing something fundamental about confidence, about scarcity, about what holds value when uncertainty becomes unbearable. Jesse Livermore, one of the greatest traders in history, called this the market telling you something. And his advice was simple. Smart money listens before asking why. The question isn't what caused this move. The question is, what is this move revealing about conditions underneath the surface? And what it's revealing is a disconnect so extreme, so mathematically impossible to sustain, that when it resolves, the repricing won't be gradual, it will be instantaneous and violent. Because here's what nobody is connecting while they stare at green candles and celebrate the bounce. Physical silver is near impossible to source right now. Not difficult, not expensive, impossible. Bullion Star, one of the largest physical dealers in Asia, just posted an update that should terrify anyone still trading paper contracts. The physical market is under serious stress. Silver especially near impossible to source. Mints closed, refineries backlogged, most competitors empty. They have inventory because they planned ahead. They accumulated when others were complacent, but even they've had to adjust. They reduced both buy and sell minimums from 20,000 Singapore dollars down to 10,000. That's not a business decision to expand market access. That's a response to stress. That's acknowledging that in conditions like these, access to physical metal matters more than price optimization. And they explicitly stated premiums are set to reflect real physical market conditions. Translation: the spot price you see on Bloomberg screens has decoupled from the cost of acquiring actual metal. The paper price is theater. The physical premium is reality. Now let me show you what I told this community before this move happened. In yesterday's video, I mentioned the possibility of a move toward $87 to $90. At the time, we were trading around 80. That level represented a key confluence of technical factors that I won't fully break down here because it requires a separate deep analysis. But that's our approach on this channel. We examine scenarios with real data. No hype, no greed, no fear. Just authentic analysis and a solid plan. We didn't hit that zone yesterday. But today, price touched that zone and rejected hard. That rejection matters. It tells you there's resistance there. Bulls tried to push through. They couldn't hold. They got pushed back down. And that creates the critical question everyone needs to answer right now. Is this rejection temporary before the next leg higher? Or is this confirmation that more downside is coming before the bottom forms? Remember, about 70% of this community are long-term investors, decade-long stackers who measure positions in ounces accumulated, not dollars gained. Some are short-term traders navigating volatility for profit. That's why we sometimes cover both angles, the physical reality and the paper market dynamics. Whatever your time frame, the goal is the same: to plan, not to gamble. Current prices as I'm recording: Western silver spot and futures at $85, Shanghai spot at $100, Shanghai futures at $101. That's a $15 premium, 18% above Western prices. After a 40% crash that took silver from 116 down to 70, after a bounce back to 85, the Shanghai premium is still elevated, still signaling that physical buyers in the world's largest consumption market are willing to pay substantially more than paper traders in New York. Now let me address the technical picture because this is where uncertainty lives. A few days ago I made a video discussing a critical level. If price closed below the 150 exponential moving average on the hourly chart while trading above 100, we could see the early 90s as potential support. The price initially bounced exactly as discussed. Then I followed up with another video about the Fed chair nomination's potential impact, how it could push us even lower, potentially below 86. For many in this community, that perspective was helpful. Let me be crystal clear. It wasn't a signal. It was a scenario to plan for. And as we saw, it played out. The crash happened. We went below 86. We touched 70. And now we've bounced back to 85. Here's the critical technical level everyone needs to understand right now. The 150 EMA on the hourly chart, which we used for the 86 and below scenario, is now at $96. And after this 18 to 20% bounce in silver from its lows, I'm hearing people call this the bottom, declaring the correction over, proclaiming the bull market resumption. I don't know if it is. I don't pick bottoms or tops, and I'll say it clearly. No one does. Anyone claiming they called the exact bottom with precision is selling you something. At this point, it's entertainment, not analysis. Here's what the technical picture is actually telling us. A total washout of contract open interest usually correlates with lows. With February options expiration off the board and moving into delivery, a lack of rolls combined with forced liquidations dropped total COMEX gold open interest to just 414,756 contracts on Monday. That's the lowest total since June 9, 2025. Also note the open interest drop in COMEX silver. As of Monday, it fell to 142,368 contracts, the lowest total open interest since May 20, 2025. Open interest at multi-month lows typically signals capitulation. Weak hands flushed, leveraged longs liquidated, the forced selling complete. But here's the tension. The 150-hour EMA is now at 96, acting as resistance instead of support. We're at 85, $11 below that key level. The 87 to 90 target I identified, we hit it and got rejected. That rejection matters. It tells you there's still selling pressure at those levels. Bulls tried to push through, couldn't hold, got pushed back down. So let's look at both sides, because this is where honest analysis lives. In acknowledging what we don't know while mapping what the data reveals. The bearish case first. The 150-hour EMA at 96 is now downward sloping resistance. When support becomes resistance, that's a bearish flip in market structure. We tested 87 to 90, got rejected, came back to 85. If we can't reclaim 90 and hold above it, the next test could be lower, potentially retesting the 71 low. And it's not just precious metals showing stress. Bitcoin dropped below 74,000 for the first time since April 2025. Risk-off sentiment spreading across asset classes. S&P 500 closed down 0.8%. NASDAQ declined 1.5%. The CNN Fear and Greed Index is at 39. We're back in fear territory. Global bond yields are spiking. German 30-year bond yield climbed to the highest level since 2011. U.S. 10-year Treasury yield approaching the highest level since August 2025. Japanese 10-year near the highest since 1999. This is systemic stress. When bond yields spike globally, everything else sells initially, including metals, as margin calls force liquidation across portfolios. And there's geopolitical risk escalating. Reports of potential U.S. military action against Iran breaking headlines. If true, that's a major catalyst. But understand the pattern. Initial reaction to war escalation is often risk-off. Sell everything. Raise cash. Wait for clarity. Only after the immediate panic does the safe haven bid kick in. So if geopolitics worsen, we could see more volatility before any sustained rally. That's the bearish case. 150-hour EMA at 96 is resistance. Rejection at 87 to 90. Risk-off sentiment spreading. Bond yields spiking globally. Bitcoin breaking down. More downside possible before the ultimate bottom forms. But here's the bullish case, and it's overwhelming when you look at physical fundamentals rather than paper technicals. Physical silver is near impossible to source. Mints closed. Refineries backlogged, competitors empty. Bullion Star had to lower transaction minimums from 20,000 to 10,000 Singapore dollars just to maintain customer access during stress. This isn't paper volatility, this is physical scarcity. You can't fake closed mints. You can't manipulate empty refineries. When the largest dealers in the world are struggling to source inventory, that's real. When physical is this tight and paper is trading at 85, the disconnect is extreme, and disconnects don't persist indefinitely. They resolve violently. Central bank gold demand remains incredibly strong. Central banks purchased 328 tons of gold in 2025, just below the 345 tons bought in 2024. Poland led with 102 tons. Kazakhstan added 57 tons. Gold acquisitions by central banks have continued for 33 consecutive months, 33 straight months of buying regardless of price. The 12-month moving average stands at a massive 27 tons per month. The central bank gold buying supercycle shows no signs of slowing, despite price fluctuations. These entities aren't trading, they're positioning for a multi-decade monetary system transition, and they're buying on strength and buying on weakness because price is irrelevant to their strategy. David Hunter, a credible analyst with a track record, just raised his gold price target from $5,500 to $6,800, raised his silver target from $125 to $180. That's not hype. That's analysis adjusting targets higher while everyone else is panicking. While retail capitulates, smart money raises targets. COMEX open interest at multi-month lows, lowest since May for silver, June for gold, washout complete. When open interest craters like this, bottoms form. Not always immediately, but the forced selling is done. The weak hands are out, the leveraged longs are liquidated. What's left are holders who won't sell and buyers waiting to accumulate. And here's historical context that matters. Gold price during Germany's hyperinflation from 1914 to 1923 went up 1 billion times. Monthly volatility ranged from negative 30% to plus 160%. Even with perfect foresight, even knowing gold would rise a billionfold, holders experienced gut-wrenching volatility, drawdowns that felt terminal, crashes that looked like the end of the bull market. This is normal in precious metals bull markets during currency crisis. The volatility isn't the problem, it's part of the process. It's the price of participating in the greatest wealth transfer in modern history. Fundamentally, the gold bull era is 100% intact. The story being sold by mainstream media is that because a new Fed chair will supposedly keep decision-making independent from government influence, gold needed to fall $1,200 per ounce and silver needed to fall $50. The narrative is nonsense. 3 billion gold-obsessed citizens in China and India, plus a growing band of Western precious metals holders, don't need central bank policy justification. Their focus is building savings in gold rather than accumulating more fiat currency and debt. The bull market thesis doesn't hinge on who runs the Fed. It hinges on whether underlying fundamentals remain intact. Debt levels, currency debasement, physical supply-demand dynamics, and nothing in those fundamentals has changed. The 5,600 area in gold and the $70 area in silver have historical significance as previous support levels. The silver crash was amplified by leverage positions getting liquidated, which is typical in volatile bull markets. Gold bottomed around 4,400. Silver found support around 70. Whether those levels hold long-term requires more data and price action to confirm. But here's what's undeniable. The Chinese yuan just hit its strongest level against the US dollar since May 2023, yuan strengthening while dollar weakens. This supports higher gold and silver prices in dollar terms. The pricing power is shifting east, China accumulating, central banks buying 33 months straight, physical impossible to source, mints closed, refineries backlogged, and paper is trading at 85. So the critical question, is 71 the bottom? Here's what I'm watching. If we reclaim 90 and hold above the 150-hour EMA at 96, that's bullish confirmation. The bottom is in and we're heading higher. If we fail to reclaim 90 and start testing 80 or below, more downside is coming. The 87 to 90 rejection matters. Bulls couldn't hold it. That's a warning signal. But physical scarcity and relentless central bank buying say the fundamentals are overwhelming the paper manipulation. Eventually, physical reality overwhelms paper games. The question is timing. Current prices, Western Spot 85, Shanghai 100, $15 premium, 18%. After a 40% crash, the premium is compressing but still massively elevated. Physical is still trading above paper. Mints are still closed. Refineries are still backlogged. Open interest is at multi-month lows. Gold just posted its largest one-day gain since 2008. These are not normal conditions. These are the conditions that exist when a system is breaking and most participants don't realize it yet. So where does this leave us? I called 87 to 90 in the previous video. We hit that target and got rejected. We're back at 85. The 150-hour EMA is now at 96. That's resistance, not support. We're $11 below it. More data needed. Physical silver is near impossible to source. Mints closed. Refineries backlogged. Dealers lowering minimums just to maintain access. Central banks buying 33 straight months. COMEX open interest at multi-month lows. David Hunter raising targets to 6,800 gold, 180 silver. These are bottom signals. Gold moved $311 today. Largest one-day gain since 2008. Silver up 14%, but Bitcoin is below 74,000. Bond yields spiking globally. War with Iran potentially escalating. The volatility is extreme, but that's normal in currency crisis bull markets. Here's the unresolved tension. Physical, impossible to source. Central banks buying relentlessly. COMEX washout complete. But we got rejected at 87 to 90 and now sit at 85 with resistance overhead at 96. Is this the bottom, or do we test lower first? The physical market says the bottom is close or already in. The paper market says more volatility possible. The 150-hour EMA at 96 is key resistance. We're below it. If we reclaim it, bullish. If we fail, bearish. But here's what matters most. This is war-driven price action. Geopolitical events are unpredictable. Headlines can reverse in hours. What looks like a breakout today could be a bull trap tomorrow. Leverage kills in markets like this. Even physical holders need to understand that premiums can collapse as fast as they spike. Nothing is guaranteed. Not the bottom, not the bounce, not the breakout. If you're a long-term stacker with a time frame of years or decades, this is noise. Daily swings, hourly charts, EMA tests, none of it matters if your thesis is monetary debasement, industrial demand growth, and central bank accumulation over 5 to 10 years. For stackers, the only questions are, can you source metal? Is the premium reasonable? Everything else is volatility you ignore. But if you're trading, if you're using leverage, if you're playing short-term moves, then every level matters. Know which signals you're following, know your risk tolerance, know what you can afford to lose, and if you're using leverage or trading derivatives, understand that this volatility can wipe out accounts before you have time to react. Plan for the worst, hope for the best, but never assume you know what happens next. The $311 move in gold is telling you something. The question is whether you're listening, whether you're positioned, and whether you understand that when the oldest money on earth moves this violently, it's not noise. It's a signal. And the entities who understand what it's signaling aren't asking questions. They're acting. The OG John here, signing off.